If you're watching this Tuesday, June 30th, before the cash session fully takes over, there is one thing you need to understand immediately. Silver is not just falling fast because traders suddenly stopped liking silver. It is falling because war risk has now collided with quarter-end positioning, a still hawkish Federal Reserve, and one of the most fragile geopolitical frameworks this market has been forced to price all year. And when those three things hit the same market at the same time, price stops behaving normally. That is where we are now. This is not just another weak morning in precious metals. This is a breaking point session, because the market is no longer deciding whether silver is a little overbought, a little oversold, or due for a bounce. The market is deciding whether the recent diplomatic track in the Middle East is strong enough to keep the inflation shock from reigniting, or weak enough that one more military escalation sends oil back up, keeps yields elevated, and drags silver into another forced leg lower. That is the real story, and almost nobody looking at the chart alone can see it clearly. The title of this video says silver is falling fast as war risk hits a breaking point. That is exactly right. But the part most investors are missing is what smart money is doing behind the scenes while everybody else is reacting to the candles. Because smart money is not asking the same question retail is asking. Retail is asking, how far down can this go? Smart money is asking, is this panic telling me the thesis is broken, or is it flushing leverage out of a structurally tight market before the next repricing? Those are not the same question, and they do not lead to the same decision. Let's start with what changed. Going into this week, silver was already under pressure from last week's Fed shock. The rate may not have moved, but the message did. A tighter tone, less forward guidance, a market forced to take higher for longer seriously again. That pushed yields higher, held the dollar firm, and reminded everyone that silver still has to compete with rising real returns in cash and bonds. That was the first pressure point. The second was geopolitical. The diplomatic process that was supposed to calm the oil market never fully collapsed, but it also never gave the market the clean confidence it wanted. Instead of a decisive handoff from war risk to de-escalation, traders got ambiguity, delays, regional flare-ups, and just enough instability to keep the entire peace framework feeling conditional rather than secure. That is what brought us to this week. Now add quarter end to the mix. Today is not just Tuesday, it is the final day of the quarter. That matters more than most retail investors realize. Funds rebalance, risk gets cut, winning positions get protected, weak positions get reassessed, exposures tied to commodities, rates, and geopolitical volatility get adjusted, not because managers suddenly change their long-term worldview overnight, but because quarter-end forces decisions that ordinary trading days can postpone. In other words, a market that was already vulnerable just walked into one of the most mechanical sessions of the month. That is why silver is falling fast. It is not one clean narrative. It is three layers of pressure hitting together. A hawkish Fed, a war premium that refuses to die cleanly, and quarter-end flows that amplify every move. Now let's talk about the breaking point, because that phrase matters. War risk has not hit a breaking point because the world suddenly ended overnight. It has hit a breaking point because the market can no longer comfortably price both peace optimism and renewed escalation at the same time. For several sessions, traders tried to hold both ideas in their heads. Maybe oil cools, maybe diplomacy holds, maybe inflation pressure fades. But also, maybe the region destabilizes again. Maybe shipping risk returns. Maybe the inflation impulse is not over. Silver has been trapped right in the middle of that contradiction. A market can tolerate contradiction for a while. Then eventually it has to choose. That is what a breaking point looks like. And in silver, once the market is forced to choose, it usually does not move slowly. Here is the actual mechanism. If war risk rises, oil rises. If oil rises, inflation expectations stop cooling. If inflation expectations stop cooling, the Federal Reserve has less room to soften its posture. If the Fed stays hawkish, yields stay elevated. If yields stay elevated, the opportunity cost of holding silver stays high. And if silver is already technically weak when that chain gets reinforced, the selling does not stay fundamental. It becomes mechanical. That is when stops get hit. That is when leverage longs get forced out. That is when a normal decline turns into a flush. And that is why this market feels worse than the headlines alone seem to justify. But now we get to the part almost nobody explains properly. Smart money is not just sitting there panicking through this. Smart money is doing three very specific things behind the scenes, and understanding those three things tells you far more than the price bar on your screen. First, smart money is watching yields more closely than silver itself. That sounds strange until you understand what silver is really fighting right now. Silver is not primarily fighting a supply story. It is not primarily fighting industrial demand. It is fighting the monetary pressure created by elevated real yields. If yields continue rising even as silver sells off, that tells you the macro headwind is still in control. But if yields stop rising or start softening while silver is still getting hit, that is usually the first sign the sell-off is exhausting itself. Smart money knows this. Retail usually does not. Retail sees red candles. Smart money watches whether the pressure behind those candles is strengthening or fading. Second, smart money is paying attention to the gold-silver relationship. When confidence weakens inside precious metals, capital often hides in gold before it returns to silver. That is important, because if silver is getting hit much harder than gold, it does not automatically mean the whole metals thesis has died. Often it means the market is temporarily favoring the safer monetary metal over the more volatile hybrid metal. Gold is pure monetary psychology. Silver is monetary psychology plus industrial cyclicality plus thinner liquidity plus more violent leverage. Smart money understands that when fear enters the system, gold usually gets chosen first and silver gets punished first. That does not always mean silver is broken. Sometimes it means silver is being discounted harder because it is the more emotional instrument. Third, smart money is letting weak leverage die before stepping in aggressively. This is one of the biggest differences between experienced capital and emotional capital. Emotional capital wants to call the bottom. Smart money wants to survive the flush. It knows that when silver breaks under pressure, the first move lower is often not the opportunity. The opportunity often comes after the forced liquidation, after the stop-loss cascade, after the late longs have been cleaned out, and after the market starts falling on weaker and weaker follow-through. In other words, smart money is not trying to be heroic. It is trying to be early enough to matter, but late enough to avoid being run over by leverage. That is what is happening behind the scenes. Now, does that mean smart money is bullish here? Not blindly. And this is where the honest analysis matters. If the war premium expands from here, if oil regains real momentum, if incoming data keeps inflation sticky, and if the Fed has any excuse to lean even more hawkish into July, silver can go lower. Not theoretically, mechanically. The low 60s are absolutely in play in that scenario, and in a market this volatile, you cannot rule out a deeper overshoot if quarter-end liquidation turns into a broader risk reduction event. Anyone telling you a 40% drawdown guarantees a bottom simply does not respect this market. But the other side is just as important. The structural case for silver has not disappeared. The global market has still been running persistent supply deficits. Mine supply is still slow and inflexible. A large share of global production still comes as a byproduct of mining for other metals, which means silver supply does not respond quickly even when the price screams for it. New mine development still takes years, not weeks. And industrial demand still sits on top of this market in a way older silver cycles never had to fully price. Solar alone changed the long-term equation. Add electrical infrastructure, advanced electronics, EV systems, and the broader metals intensity of modern energy and data buildouts. And you have a very different floor under silver than the one that existed in older collapses. That is why this market is so difficult. In the short term, silver can trade like a broken risk asset. In the medium term, it can still be a structurally tight metal. Those two realities can coexist much longer than most investors are comfortable with. History helps here, but only if you use it correctly. Silver's most violent corrections have not all meant the same thing. Some were resets inside larger bull markets. Others were genuine breaks where the foundation underneath price was weaker than investors believed. The key difference was never just how much silver fell. The key difference was whether the structural story underneath survived the fall. That is the question now. And from where the deeper evidence sits today, this still looks more like a market under macro suppression than a market whose long-term structure has been destroyed. That does not make Tuesday easy. It makes Tuesday important. Because what smart money is doing in a session like this is not guessing the next headline. It is testing whether the market is nearing capitulation. It is watching whether bad news is still producing proportionally worse selling, or whether the market is starting to absorb it. It is checking whether dollar strength and yields still have the same power over silver they had last week. It is comparing silver's weakness to gold's relative stability. It is looking for the point where the tape becomes more emotional than rational. That point matters because emotional markets create the most dangerous breakdowns and the best future entries. So what should you actually watch today if you want to think more like smart money and less like the crowd? First, watch oil. If oil keeps pressing higher on renewed war fear, the inflation channel stays alive and silver stays trapped. If oil spikes, but then fades, that tells you the market is still unsure whether the geopolitical risk deserves a lasting premium. Second, watch the 2-year yield. Not because it predicts silver perfectly, but because it tells you whether the market is still tightening the rate path in its head. If silver is falling but the 2-year stops confirming the move, that divergence matters. Third, watch gold. If gold holds together while silver gets hit, that usually tells you the market is rotating within metals rather than abandoning metals altogether. Fourth, watch how silver behaves around weakness. Does it break and keep accelerating, or does it break, flush, and then stop attracting fresh sellers? Exhaustion often looks ugly before it looks bullish. And fifth, remember what kind of day this is. Quarter-end sessions can exaggerate truths, but they can also exaggerate distortions. Not every move made today is a clean statement about the next 3 months. Some of it is positioning. Some of it is optics. Some of it is funds cleaning up books. Smart money knows the difference. Retail often does not. That is why titles like this matter. Silver falling fast as war risk hits a breaking point sounds dramatic, and today it is dramatic. But what smart money is doing behind the scenes is the more important half of the sentence. Because while the crowd is reacting to speed, smart money is analyzing cause. While the crowd is arguing about whether silver is dead or moonbound, smart money is asking whether this is an inflation shock being repriced through a thin market or the beginning of something structurally worse. That distinction is everything. If this is just a war-driven extension of the same macro pressure silver has already been fighting, then the sell-off is painful but understandable and eventually reversible. If this evolves into a lasting inflation problem with a still hawkish Fed and unstable shipping risk, then silver may need more time and lower prices before the larger thesis can reassert itself. Either way, emotional reactions are not the edge here. Clarity is. And clarity right now says this: silver is under real pressure. War risk has reached a point where the market can no longer comfortably ignore it. And smart money is not blindly buying the dip or blindly fleeing the trade. It is watching the pressure points. It is letting leverage clear. It is measuring whether fear is still gaining force or finally burning itself out. That is how serious capital operates in a market like this. So if you are watching silver this Tuesday and wondering whether the move is just another dip or the start of something bigger, stop asking only what the price is doing. Ask what is driving it. Ask whether yields are confirming it. Ask whether oil is extending it. Ask whether gold is diverging from it. Ask whether today's liquidation looks thoughtful or forced. Because if this is a clean macro breakdown, silver can still get uglier from here. But if this is quarter-end panic layered on top of war fear in a market whose long-term structural case is still alive, then what feels most dangerous today may later look like the moment smart money quietly got interested while everyone else was too distracted by the speed of the drop to notice. The market is treating silver like a broken trade. The deeper evidence suggests it may be a stressed trade sitting inside a still unfinished structural story. And those are not the same thing.